China holds trillions of US dollars. In theory, they could sell them all tomorrow. But in reality, doing that would hurt China almost as much as the United States. And that's why this money is far more powerful sitting still than being sold. By the end of this video, you'll understand why China owns so many US dollars, why they can't simply dump them, and how this quiet financial relationship affects your job, your savings, and your cost of living, even if you never think about global finance. To understand this story, we need to step back. For decades, the US dollar has been the center of the global financial system. Oil is priced in dollars. Global trade is settled in dollars. Central banks hold dollars as reserves. Here's the key point. The dollar isn't just America's currency, it's the world's default currency. Now, enter China. Over the last 40 years, China became the world's manufacturing hub. They exported enormous amounts of goods, electronics, furniture, clothing, especially to the United States. When Americans bought those products, they paid in US dollars. Those dollars didn't disappear. They flowed into Chinese banks, companies, and eventually China's central bank. This is where it gets interesting. China didn't pile up dollars by choice alone. They accumulated them because global trade is built around the dollar. So instead of holding stacks of cash, China did what large countries do. They invested those dollars, mostly into US government bonds. That's how China ended up holding trillions in US dollar assets, not as a weapon, not as a threat, but as a byproduct of the system itself. Let's break down how this actually works, step by step. First, the US buys goods from China. Americans import more than they export. That creates a trade imbalance. China receives dollars in exchange for goods. Those dollars land in Chinese banks. Now China has a choice. They can let those dollars sit unused or invest them in something safe and liquid. Here's the key point. There is no market more liquid and trusted than US government debt. US Treasury bonds are essentially IOUs backed by the US government. They pay interest, they're easy to buy and sell, and the market is massive. So China recycles its dollars back into the US financial system. This creates a loop. US buys goods, China earns dollars, China buys US bonds, the US gets cheaper borrowing, consumers get lower prices, everyone benefits, at least in the short term. This isn't a secret deal, it's how the global system evolved. And it's why China holding US dollars is not unusual, it's expected. So why can't China just dump everything? On paper, it sounds powerful. In reality, it's self-destructive. Here's the key point. If China tried to dump massive amounts of US bonds, bond prices would fall. Interest rates would rise. The value of the remaining bonds China still holds would drop. China would be hurting its own balance sheet. But it goes deeper than that. Selling dollars means converting them into something else, euros, gold, or other currencies. That would push the dollar down and push China's own currency up.
This is where it gets tricky. A stronger Chinese currency would make Chinese exports more expensive. That hurts factories, jobs, and growth inside China. So, dumping dollars doesn't just hit the US, it hits China's economy directly. This is why the dollar holdings act less like a weapon and more like a financial anchor. Both sides are tied to it. And here's something many people miss. If China could easily replace the dollar, they would have already. But there is no alternative market large enough, liquid enough, and trusted enough to absorb trillions overnight. So China manages its holdings slowly, quietly, and cautiously. Not because they're trapped, but because the system rewards stability more than shock. Now, let's bring this back to you. This relationship affects everyday life in ways you don't see. When China buys U.S. government bonds, it helps keep U.S. interest rates lower than they would be otherwise. Lower rates affect mortgage costs, credit card rates, and business loans. That influences how affordable homes are, how much companies invest, and how many jobs get created. It also affects prices. For years, cheap imports from China helped keep inflation down. Everyday goods stayed affordable. But there's a trade-off. Domestic manufacturing shrank. Certain jobs disappeared or moved overseas. Wages in some sectors stagnated. So, the system delivered lower prices, but also reshaped labor markets. And your savings? Stable demand for U.S. debt helps keep the dollar strong. That protects purchasing power, especially for imports. This isn't abstract finance. It's part of why your phone costs what it does, why loans are priced the way they are, and why global shocks ripple into local economies. So, what happens from here? The most likely future is gradual change. China has already been slowly reducing its dollar exposure. Not dramatically, not loudly. At the same time, global trade is becoming more diversified. Supply chains are shifting. Currencies are slowly becoming more regional. Here's the key point. This is not about sudden collapse. It's about slow adjustment. Possible paths include more regional trade systems, slightly higher long-term interest rates, less dependence on any single country. The dollar remains dominant, but not untouchable. And China remains invested, but more cautious. The system evolves because it has to, not because someone pulls a switch. Let's recap. China holds trillions in U.S. dollars because global trade runs on the dollar. The U.S. buys more than it sells. U.S. bonds are the safest large market available. China can't dump those dollars because it would hurt their own economy. It would devalue their remaining assets. There is no easy alternative. This relationship isn't about power plays. It's about incentives, stability, and trade-offs. And understanding it helps explain how global money quietly shapes everyday life. If you value calm, clear explanations of finance, economics, and global systems, subscribe to Capital Chronicles World. We focus on understanding how money really moves and why it matters to your life.